Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. Well, it's only befitting that we are kind of ending the Talking Point series for the current year. Of course, we will continue this in 2021. All I'm saying is last couple of episodes of Talking Point of 2020. And it's only befitting that we're talking with the person who got most of his calls right all through 2020. It's just, I was a bit unnerved over the few interactions that I did with Shankar Sharma and Devina, because most of the things that they said turned out to be right. The question to him now is that is he kind of skittish about his opinion for 2021, or is he bullish about the year as well? Because most of the notes, Shankar, that I've read from all houses seems to suggest that they are all bullish on equities. Firstly, thank you so much for joining in, and I hope all is safe.
Yes, everything is fine, and I'm rather concerned at hearing about your travails in Dubai.
Yeah, well, some things work out, some things don't, but that's okay. But Shankar, lovely to see you, of course. And how do you analyze the year gone by? But I mean, we've done that enough to death, maybe. But does that leave you with any thoughts about how 2021 could turn out to be? Predictions have turned out to be completely futile at the start of 2020, I'm sure. But can it be different in 2021?
I think it can be. So, I mean, the thing is, if you go back to the January of 2020 of this year, where we are right now, uh, when we entered January of 2020, uh, not as an Indian investor, but if you look at the entire world as we do and we invest across the world, the thing that was most striking was how easy money making had been in 2019. 2019. Okay. It was a knife through butter year. It was amazing. It was just like you could pick anything and we made a ton of money. I mean, our fund was up 39% in 2019. Okay. Now, when we entered 2020 in January, we were all very pumped up. We were all very complacent. We were all thinking that this is another repeat that we are going to see. And it didn't turn out that way, right? So again, we are entering 2021 with a similar mindset that 2021 is just going to be a straight carbon copy repeat of 2020. And if there is anything in markets you can believe in safely, is that they're never predictable. So, if you were to go by that basic logic, this year may well hold some surprises for us. That said, my belief is, based on all that I see, that number one, given the overall low interest rate environment globally and in India, equities become the only alternative, more or less, as also commodities. Okay, so basically, on the other end of the seesaw of interest rates, you have equities and commodities. And I think there is no real competition there because I do not think interest rates have anywhere to go but remain flat. They might even be eased, or at least they don't go up, in any substantial way. So if that is an assumption that we can work with, then the rest of the other end of the seesaw work themselves out quite simply, which is basically equity should do well, and your commodities should do well. And if you see, that's been the last 3 4 months, you started to see commodities, do particularly well. The other thing is that with these low interest rates, the riskier end of the markets will end up doing better than the so-called less risky end of the market. So that's the other thing, right? That this year, 2020, we have seen that tech, which is often the more risky end of the market, has done better than non-tech, okay, in the US. Even within tech, if you see, the better performers have not been the FANG stocks. They have actually been very tepid in the last 4 5 months time. They had a big move from April up until June, July, and after that they're really flatlined. So really, it has been the second or third tier tech, let's say the more risky end of the tech market, which has done better. So you can see that risk is something that people are embracing, completely.
Hmm.
At every level of the game, the risk is being embraced. So let's say in India, large caps were just tepid this year. So Nifty is up maybe 4, 5, 7% or something like that for the year, while small caps have had a big move this year. Okay, so at every level you are seeing people being very happy to embrace risk. I don't think that perspective is going to change, but we are very complacent. Markets do give us nasty surprises. Let's be prepared for that.
Yeah, fair point. So, Shankar, can I ask you? So, I mean, I was reflecting upon all the conversations that we've had this year, and boy, you guys got it right. But you also said that you move like a hare. You're not married to being a bull or a bear. I remember um, somewhere before Diwali in October or thereabouts, you had mentioned that you were a bit concerned about this whole Chinese incursion into India. We were at 12,000 then, and you had mentioned that they have not come for a walk in the park, and there is a possibility that led by that or something else, the markets may maybe come off a bit. I think the liquidity just really came in gushes, and we've gained 2,000 points since then. Are you
So,
circumspect about um, say valuations per se, or do you believe that because the overarching view seems to be that there is no alternative, despite the valuations, we might continue to do well for world markets at large and maybe for India too?
so again, bear in mind one more thing, that a lot of money has come into India in the last couple of months. We all know that, right? Now, India might be up maybe 10% in the last 2 months. I mean, around that much, right? From October, November up until now, around that much, I think. I mean, Brazil and Russia are up nearly 40% in the same period while not having had anywhere close to the inflows that India has had. Think about it. So we all keep looking at India as being the center of the world. The reality is that we will broadly mirror a trend which is being played out in other parts of the world, in particularly in peer groups. Okay, so money has moved away from US dollar assets into emerging markets. In that, India has got a lion's share. But despite that, India is still year to date and in the last 2 months at the bottom end of the performance spectrum. That is what really concerns me. It's not about the liquidity flows into India. It's not about if you viewed India in isolation. Everything looks good, but ultimately you can't view things in isolation. When you expand the frame, you say that this market has taken several $billion in, and yet it is not beating emerging market peers. In fact, it has lagged emerging market peers, barring China, for its own problems in the last 2 months' time. Why would that happen? That is the question that I am struggling with. I mean, 10, $20 billion of money should have propelled this market up, I don't know, 50%. So the central point here is important for all viewers to understand is stop looking at money flows to determine where markets go. It is a dumbest thing in this world. Money flows and market direction has no correlation at all. So countries which have seen FII outflows have done better than countries which have done FI, which have received massive amounts. So Brazil, Russia FIIs have been very tepid, probably out. They have done better. Turkey, nobody wants to invest in it. Look at the Turkish market in the last 2 months' time. India, everybody's favorite for last 2 months, it has not done as well. That is the larger picture that must come through to viewers, that India, I think, needs to get its economic act together for equity markets to really deliver. Because ultimately, flows and global sentiment can take you only so far.
Okay. So you reckon that this underperformance could it be in part due to maybe the previous performance of these markets, or do you reckon that there are other factors at play? Because I heard you mention that India needs to get the economic act together in order for the markets to perform, but that may happen over a period of time. Why is it that you think India is underperforming relatively?
That is because if you look at the scale of economic decline this year, forget growth was not being discussed this year, barring for a couple of markets like China and Taiwan. If you look at the scale of economic decline this year, India has been right at the bottom.
Hmm.
Okay, right at the bottom, even compared to European countries which were very badly hit by Corona. So markets, I don't think markets are very intelligent, organisms, but they sometimes can discern between things, and it has discerned that India's scale of economic challenge to come out of this trough, the -10% trough or -8, but whatever the number eventually is for this year's final GDP number, is going to be a long haul. Because remember one more very important thing. I don't know what the data on your Bloomberg screen shows you, but I think this year India is probably what's between 5 and 10% up,
Yeah,
something like that. In
yeah.
in 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 dollar terms, maybe about 3-4% up. Euro terms, it's about 2% up as of last Friday when we were running the numbers. This is the third year in succession that India has delivered virtually no returns. Bear that in mind. 2018, India was down 3%. 2019, India was up 7%. That was a year in which every global market took the ceiling off in terms of their growth rates. Okay, 2020. Okay, India is just flattish or +2, +5% there or here or there. So markets have discerned that India needs to get its corporate act together, needs to get its economic act together, because corporate earnings, we all know, have been big disappointments over several years, and economic growth was already tepid going into this crisis. Coming out of the crisis will be a challenge for India. I mean, given the fiscal problems and all that, we know it's not no mystery. I think the markets are telling us that we need lots more money to rally. I mean, 10-20 billion is not enough. Let's just this way.
So can the gambler's fallacy hurt investors in 2021? 3 years we've had a growth. Now it's the time to come. And yes, you have to admit that it took 2020, a crisis year, to surprise people on the upside on the earnings front. But I mean, that's silly, of course, because people just estimated so low that yes, India was able to surprise. Can 2021 be different in that sense? Can we return to
I
growth
think
and earnings and market performance?
so. I think one thing I do believe in, as far as data so far, or or everything so far confirms that the riskiest end of the market, which is the small caps, which have had a terrible 2018, 19, 2020, they started to revive. I'm talking Indian small caps, but actually, even elsewhere, small caps have had a decent run this year. So I think you may well see small caps have a very good year in 2021, because risk appetite means you go and buy riskier end of the market, and I don't believe they are very risky per se, but they are more prone to a bout of sort of big euphoria or big hysteria. And I think cyclically they're due for a big move up. So I think small caps are a good place to be in. Large caps might be very patchy. I mean, that's a different discussion altogether. But I think small caps as a category will be a good place to be in 2021 in India.
Okay. Now, before I just kind of dovetail into India, Shankar, just a couple of other questions. All through the last 12 months, I'm just trying to figure out your preference for different markets, because I guess you trade different. Do you reckon India could, as a market, could do relatively better than what it has compared to what it has been able to do in the last three? That is part one of my question. Part two of my question would naturally be gold, because you've been unequivocally bullish on gold all through. What's your sense now?
So India, in my view, at the worst, should be a market performer to emerging markets, which is where it has been even this year. So for all the song and dance and fury, it is more or less flatlined against emerging markets. China has done phenomenally well, barring the last couple of months or last month. But there are other markets like Korea or Taiwan, and like I mentioned in the last couple of months, like Brazil and Russia, which are more commodity heavy markets. They have been absolutely on a blowout kind of phase. So I think India will do well if it market performs compared to emerging markets. I don't think so far. Again, we'll be flexible. We'll keep our minds open that India can have a relative big year relative to its peers. Okay. Because if there is a commodity bull market, which I do believe there is one, okay, This is to answer your question on gold. It's not just gold, silver is doing well, platinum is doing well, palladium is doing well. If you see, oil has done phenomenally well from the lows of March, up until now, it has been better than many equity stocks. So it's been up 3, 4 times. So commodities overall look to be a good space. If commodities do well, India's market composition is not very commodity heavy. So there are other markets which are very commodity heavy. So you have a Russia or a Brazil or a South Africa, which have a large number of miners or processors of various metals. They typically do better in big bull markets for commodities. But that said, if there is a commodity boom, which I think it is, then you will be able to play that to some extent through the Hindalcos and the steel companies in India. So I do believe commodities are a good place. Gold is good, silver is good, platinum is good, oil appears to be okay, copper is great. So if all that is good, India will be around the market because there are better places where you can have all commodity plays, like I mentioned, the Latin American markets or even the South African market. Uh, but overall, I think if you go back to 2003-4, that was the kind of market we had. We had a big dollar weakness. We had a big bull market starting in commodities and therefore in emerging markets overall. And we had a good 3, 4 years before everything flamed out. Hopefully, we might get a repeat of that kind in 2021 and 22.
I'm waiting for your answer, Shankar, on this one. I think you will say, oh, Shah, don't say that. But a lot of people have likened this onset of this up move to 2003 to 2008.
It's possible because,
Oh, okay. I'm surprised
yeah,
saying that.
it's possible. But I mean, remember that. I mean, the scale of the move may not be as much. Now, I'm not talking only for India, I'm talking for all emerging markets. Because 2003-4, we had a terrible 2000, from 2000, I think February, March, when the tech bust happened, right until 2003-4, India and emerging did very poorly. So you were at the lows. You were at the lows. It was not that you were at the highs. So a lot of that big upside move has, to some extent, been captured already. India was not trading at an index of 20,000, right? On the Sensex, it was already 30, 35,000. From there, we are at 45, 46. So 2003 was different in that sense. It was coming out of a massive bear market in the preceding 3, 4 years. This time, I do believe you might get a big emerging market, bull market. But to expect a 50% compounding like what we saw between 4 and 7, which was the best ever period we have seen for Indian equities in the last, I think, 25, 30 years. In a 3, 4 year period, we compounded 50% plus. That's a bit much. I think I'll be happy that we get a 10, 15% move, up move, maybe 20% in 2021. I think that'll be great. If we get that, I'll be a satisfied man.
Okay. Shankar, how can that happen without financials participating? You largely, unless I'm wrong, have been negative Indian financials.
Yeah.
Can we do well without financials participating, or other financials moving lower from where we are right now?
So, I mean, the point is simple, that Indian financials have been terrible this year. Okay. So for all the sound and fury, year to date, I think the BankX is probably up 2%. Okay. Most banks, ICICI, Axis, or HDFC Bank, Kotak, are flat or still down for the year. Okay, let's not even speak about the lesser private banks. So broadly speaking, year to date, the index is nothing worth writing home about, the BankX. Okay, that's not the game we play. The stocks we own, the companies we own, are up year to date. They are up 50%, they are up 100%, they are up 500% year to date. We are playing for that. We are not playing for a market that, an index that goes from 100 to 50 and then back from 50 to 100. What are we getting? Then we are becoming traders, right? And you really cannot trade in a fund as a personal trade. I know banks will do well when COVID vaccine comes out. It's no rocket science, but can you sell stocks which they are visible, their earnings growth, all the ducks are aligned, and sell them and buy things which have been beaten down and crushed just because they're going to rally a bit. So that's a different strategy, different discussion, or a different decision. The fact of the matter is, Indian banks have benefited from the moratorium because that has helped paper over a lot of traders underneath. Okay, and RBI came out with a note yesterday, clearly saying that there's 40% of the moratorium, and it will raise sort of bad assets once this thing goes. So under the cover of the moratorium, Indian banks have taken this opportunity to rally. I don't know whether that is it's as hunky dory. When you pry open this cover and look inside, the reality will be as pleasing to the markets. So therefore, we stick with things which are doing well. Numbers are strong. Outlook is good. China factor is playing in their favor. We will sidestep the financials for now. I mean, that's the simple thing. There's no big opinion that they're bad. They're great companies in certain kinds of markets. Right now, we find far better places to put money.
Actually, I was gonna request you to tell if you can. I mean, currently as things stand, as you're positioning your portfolio for 2021. I mean, I'm not saying you position for the year. You said that you are ahead and you could change, but I'm just still asking. Um, what quantum of your positions would you be comfortable allocating to India vis-a-vis commodities and rest of the world equities, etc.? And within India, what do you think has the higher probability of doing well as things stand right now?
So, I mean, in a global funds, India is about 2% to 2.5% of the portfolio, and which is more or less around the other emerging markets. Of course, there are others. The better ones are more. So I think that's about what India merits on a global basis, right? Within India, we don't see any reason to have a big wholesale shift, okay, into all financials or all the beaten down, or let's say the more volatile end of the market, because a lot of the demand things that we are seeing right now are still merely because you've deprived a country for 8 9 months of buying goods and services. So when you open things up, there will be a big rush, big pent up demand for real estate, for automobiles, for eating out, going to a mall, everything. So we need to see whether that is sustainable or not. That data will be available only 3 months out. Till then, there is no reason to suddenly do a wholesale shift and go and put everything into this let's say the cyclical end of the market. I think IT will continue to do very well. In part because of the COVID itself, I don't think they will ever go back to working the way they were working before. So margins are here to stay. The other very important thing is the dollar has weakened against almost all emerging market currencies, okay, barring India. So if you see, the rupee has been one of the weakest currencies in the emerging market pack overall in 2020. Now that is a very important piece of data. That other currency like the Philippine peso, Taiwanese dollar, they're up 2% or up 5%, 6% versus the Chinese yuan versus the dollar. But the rupee, I think, is more or less flat or might be slightly down for the year. So that tells you that inherently the rupee is going to remain weak. If the rupee remains weak, because we were concerned when the dollar started to weaken that should we do something about our IT position? Because if the rupee does not, remain weak, and in fact strengthens, then we are going to have a problem on IT earnings. But that has been belied by the movement of the rupee, because the rupee has remained the weakest currency in the entire emerging market pack. And if that continues, IT remains a very good place to be. So that trade has worked brilliantly for us this entire year, and we continue to like that space. No reason to change that yet. But we are playing the cyclicals to some extent. So we bought JSW, we bought Hindalco, about 4 5 months back. They have done very well because, we saw a big global metals rally, and, so we have played the ones that we felt confident about, even though they may not be qualified as quality businesses per se, but we haven't been as brave as to go out and buy banks.
Yeah, sticking to your stance, so to say. Shankar, the other question would be that this noise and murmurs around, the whole manufacturing uptick that will come in. How enthused are you about these PLI announcements as well? We could have one for autos also tomorrow. The market seems to be liking some of them. I mean, Dixon has been the kind of the poster boy of the PLI scheme and the manufacturing space. But what do you think about the others?
So I was laughing yesterday that contract manufacturing is probably the second oldest profession in the world, after the one that we know about. So, it has been around for decades across the world. And, there have been big companies built out of it. I mean, in India, it's a new phenomenon, but contract manufacturing has been going on for decades. American companies outsourcing, to Taiwanese companies or even to Chinese companies, Thai companies. So it's a well set standard business. There is no rocket science to this business. There is no tech in this business. It's only you build capacities and you benefit from it. It's a relatively low margin business. You just play on the big scale that you can get. It can be a good business done right. And I think in India, because there is paucity of choice, because it's still a nascent business, and that's the beauty of this country, that the businesses which are giant businesses elsewhere are nascent businesses here. They are that far back in the scale of evolution, but we will take it. I mean, it is what it is. So Dixon trades at a fancy multiple. We own it, by the way. It trades at a crazy multiple for a manufacturing company, making a very razor thin margin. But given the fact that there are not that many options available, market will keep going towards stocks like these. I do believe that, in part, people do want to move away from China, and some part of the capacity will seep into India because India has the sort of size of labor force available. Whether the labor works or not is another matter, but at least it's on paper there. So I think, to some extent, story is right, and to some extent, it will play out. But I mean, let's not always believe in India that everything plays out perfectly. I mean, I think the only story that India really hit out of the park was the IT services story. That when it started, it appeared like a good business and a good story, and it actually delivered far beyond what we thought. Let's hope manufacturing and outsourcing and contract manufacturing does even 10% of that. I mean, I think it'll be a big, big boom for this segment, without doubt.
Not pharma. I mean, you don't think pharma is kind of on the global scale?
No, pharma is good. We own it. I mean, so I mean, I'm just
No, I was
talking
wondering
about.
since you were talking tech, that's why I was wondering.
No, so pharma, I mean, in India has been, a, a sector we've seen for 25, 30 years, not a new sector. The API one we have played, it's largely old wine and new bottle. It's a shinier bottle, and I'm told there is more tech involved in this. But basically, we played the story in 90s also. Then it went away for 15, 20 years. Then it's come back in a new avatar. While not getting carried away, we have played the sector, played the moves in some of them, and I do believe pharma continues to be a good space. So, like I said, there's no reason to make a wholesale shift just yet. At the
Got it.
margin, we are playing the higher beta end of the market. It's not that we are sitting it out.
Okay. Last couple of questions, Shankar. One, a lot of people are, or a few people, let me put it that way, are believers that the driver of the recovery, whatever happens, real estate would play a large part in it, actual sales and ancillaries around. Do you believe in that? I know you watch this space closely. Do you believe that real estate could see a recovery?
So from wherever it has been, there will be a recovery. There is no doubt about it. I mean, it has been literally the worst hit sector.
Yeah.
So anything from where it was will appear like a big bull market. So there are some tweets saying there were no apartment sales in my complex for 7 months, and now in eight apartments have been sold in a week. I mean, eight is not a lot, but I mean, from zero, it appears like a huge, huge, growth cycle. So yes, real estate will see a revival. How much? I'm not a big believer in that space anyway, because it's my belief, as a consumer, that you would be an idiot to buy real estate, given the fact that rental yields in India are at 2%. Okay, why would you ever borrow at 7%, 8% to buy a 2% asset, unless you see a big revival in the price of the asset itself? And which, given the extent of the supply, I don't think you can really bet on a big boom in prices on a per square foot basis. And plus, buying real estate binds you to a certain place. Okay, most people wanted to be in Mumbai or in Delhi. Now there's no longer a compulsion. There can easily be. I mean, my company, many people have gone back to their hometowns, and life has been good. They don't have to come back to Mumbai to resume work. I, I'm not a believer that those structural changes, or those changes, are just cyclical and not structural. So, given that, I don't think there's going to be a huge upswing in prices. And therefore, you might see a cyclical recovery in real estate, but I don't think it's going to be durable.
Okay. Lastly, Shankar, any personal resolutions? Anything that you believe 2021 would be must do's? I know travel is on top of mind for everybody, but for you, it may be a new wine, a new place to visit, a new restaurant to try, what have you.
Yeah. So, I mean, I'll keep it under the wraps, but I have a personal goal. Well, not really a goal. I mean, it's something that I'm building, and hopefully by the end of the middle of the year, hopefully it should be ready.
Inshallah, I hope it works out even better than what you anticipate.
Sure.
Shankar,
Thank
thank you so much for the entire year. You've been very kind and spoken to us on most occasions when we needed a sane voice. So thank you for that. And all the best to you and your family for a splendid 2021.
you, Neeraj, and you be safe, and get out of those confines as soon as you possibly can.
Thank you so much, Shankar. Appreciate it. Thank
Thank
you.
you. Take care. And all the very best. Sorry, Christmas is done. Happy New Year. Happy 2021 for you as well as your entire team.
Thank you so much, Shankar. Really appreciate it.
Thank you. Bye.
And viewers, thanks for tuning into this really nice and informative conversation with Shankar Sharma on Talking Point.